Okay, looking at gold, off a little bit today, pulling back from a 13-month high on weaker economic data. Still, though, obviously above 2,000. Gold since the start of the year up just about 10%, hovering above that critical $2,000 level here and just trading just about $50 below its record high. We want to bring in Bob Iaccino. He's Path Trading Partners co-founder and chief market strategist. Bob, it's good to see you here. So we're holding above that 2,000 level. I think a lot of investors are asking if there's really upside here to the price of gold. What do you think?
I think there is. Gold was my big call for the year. I'm sticking with that as of this point. I still think we're going into a recession, although the timeline may be pushed a little bit. The yield curve says we're already there. Economic data has kind of started to slow. And if you're long gold, which I am, the best case scenario is the Fed cuts rates to get you out of a recession, which is positive for gold. Worst case scenario, the Fed continues to raise rates. I think this is the least likely. And they hold the pause a little bit longer. 2 out of 3 of these cases is good for gold. The worst case scenario is that they hold the pause and we actually get this soft landing or easy landing or even no landing. That wouldn't be great for gold, and I think that's the least likely scenario.
Fed certainly plays a role. Bob, talk about some of the other factors driving the prices where they are today.
Well, again, you have this issue of asset prices being sold off, and gold has always taken advantage of that. And what's generally happened is the Fed, again, bringing that out, cuts rates to help the economy and to help asset prices. That's been a driver of gold in the past, and a lot of people believe that. CME Fed Watch Tool has cuts starting in July of this year, which the Fed says they're not going to do. Another one is people think of gold as an inflation hedge, and it's really not. What gold is it's an asset. And if you look at assets in general, when inflation starts and then continues to rise through, gold powers through that because it's an asset. Just like house prices, just like stocks, we forget the good part about inflation is asset inflation, and gold is an asset. The problem comes in for gold investors when the Fed starts to aggressively fight inflation. So something we haven't had, which has contributed to gold's underperformance over the last decade or so, was we haven't had inflation, so we haven't had a Fed to fight inflation. And that's kind of gave gold this weakness. When inflation started, gold rallied. We saw that March spike that references almost the all-time high that Shauna mentioned. We're driving toward that again. And if we are in a situation where, as Neil Dutta from Renaissance or at Macro put it, inflation remains unaddressed, then gold's going to benefit from that.
Bob, how much upside is there to gold? Are we talking 2,500? Are we talking above that?
But here's what people think I'm nuts. I think we can easily break to new highs. And I think if it goes the way I think it's going to go, easily within the next 12 months, we could see 2,800. I used to say by the end of the year, I'm not saying that anymore because I think the Fed was much more aggressive than I thought they would be when I made that call. But I think the issue here is the popular opinion, and the politically popular opinion is that the Fed should stop trying to fight inflation. And I don't think people realize how bad that is for the whole country as opposed to just 2 or 3 million people. And I don't mean to downplay that. I want to stress that. But the 2 or 3 million people that may lose their jobs in a recession, as investors should look at it, is good for gold. Is good for stocks. It's not necessarily good for gold. Where gold outperforms is when there's inflation and a recession. And I think that's what we're going to, because I think the Fed is going to cave into pressure and stop fighting inflation.
2,800 call. Gutsy. All right, Bob, with that, we want to play a little game. We want to see how deep your love for gold goes. We're calling this Bob's Buys. We'll give you a choice between 2 investments. You'll tell us which is the buy and why. First up, Bitcoin, which has been surging with gold, which seems a little odd on its face. So Bitcoin or gold?
So I have to ask you a question first, and we actually did this with a recent guest on our podcast. Yeah. Is this 100% in one or the other?
Is it 100%? I'm not sure.
You mean all in on gold or all in on Bitcoin?
Yeah. Can I go 70-30 or I can't do that?
Oh, I see what you're saying.
Sure. You can make your own twist to the game. We're open to suggestions, Bob.
Well, look at you making up your own rules. All right. I was going to say 100%, but go.
Well, actually, if you make me pick 100, it's gold. I am actually in about 70% gold, 30% Bitcoin for that amount of the capital that we allocate to this sort of space. Because I think the issue with Bitcoin is it here in 10 years or not? I think it is, but I don't run that sort of part of the game. So.
All right, Bob. Well, we're setting you up here because we got a couple to get through. So the next one's up is Treasuries tips or gold. What do you think?
Gold.
You're sticking with it. Didn't even have to think twice about it.
I want to get back to the prior answer. What do you make of the dynamic, though? Gold rising typically tells us people are risk averse. How does that rise with arguably the most speculative asset on the planet in Bitcoin? How do those rise together?
So Bitcoin has a couple of things going for it. It's again beginning to perform in a non-correlated way, which I like. It hadn't done that. It was correlated very sharply to the NASDAQ. That's not the case anymore, at least in the short term. If that sticks with it, then a non-correlated asset is always good in any environment. So that's really the core of it.
All right, Bob. And last up here, I-bonds or gold? What do you think?
Wow, that one's tough. I'm going to have to say gold too, but I think if you put me in a position, I'd go 60% gold, 40% I-bonds.
All right, there we go. All right, gold, the winner of all three. You're the gold guy, so maybe we shouldn't be surprised by that. Bob, great to see you. Thanks so much.
Good to see you guys.